Welcome back to chapter 5. Yeah, we're on chapter 5 already. Inverse fair value gap strategy. What is it and how do we trade it? Well, the first thing you'll need is an indicator. So as we did in the last video, click on indicators and in the search bar type FVG. And FVG Nephew Sam is the one you want. It's currently at 6588. Click on that, that will add it to your chart. Once it's added to your chart, go in and change the settings to these. So time frame 1 is 1 minute, time frame 2 is 2 minutes, and so on. You can take these however you like. This is what it's going to print on your screen. Make sure they're all activated. Extend boxes I have off, otherwise the boxes go too far to the right. Wait for a close, so filled FVG type should be closed. Wait for candle close to identify FVG and delete boxes after fill and hide FVGs lower than enabled timeframes. So yours should look identical to this. So I'll leave that on the screen for a second, take a screenshot, make a note. Okay, that is going to enter the fair value gaps onto our chart. Now, what is a fair value gap? So that's probably the very first question we need to ask ourselves. A fair value gap is formed from 3 candles. It has to be 3 candles. So that's candle number 1. That's candle number 2. That's candle number 3. The gap between the top of the wick from candle number 1 and the bottom of the wick from candle number 3 leaves a gap. There's a gap between this and that. That is a fair value gap. So wherever you see a fair value gap, that means that there was an imbalance. There was 3 candles and the gap between the first and the third candle has resulted in a fair value gap, an imbalance. So on your chart, or on my chart, you'll notice that I've got several that have different M's on them. So 1M's and 2M's. These are from the higher time frames. So we use these in order to find out if we can take a trade, when we should take a trade, or even if we should take a trade. So when you have identified the fair value gaps, I have mine currently as red for bearish when the market's moving down and green for bullish when the market is moving up. What we need to see before an inverse is a sweep of liquidity. So we need some type of liquidity to be taken. So if we move over here, I'm just going to find some, I think. There was one last night. This was from the PM session, the New York PM session yesterday. So I'm going to use this as an example. We've got a gap. We've formed a gap here between this candle and this candle. This box identifies that fair value gap. So what's the first thing that we're waiting for? A sweep of liquidity. So we know from the earlier liquidity video that there will be liquidity residing above here, liquidity residing above here. This candle come up, or candles come up and swept this area. So that's our sweep. We've come up and swept liquidity from that area. The next thing we're waiting for is the FVG to be inversed. And by that, what you're looking for is for, in this instance, obviously it's a sell because we've swept above, so we're expecting a move to the downside. So that fair value gap that we've got a box around, we're waiting for a candle to close below that fair value gap, and it did just there. So you can see the candle close is just a smidge below this fair value gap. So that is our entry. Once you've entered the trade, what are you targeting? You're targeting the next area of liquidity. Well, we know that we've got an area of liquidity underneath here because we know that above the highs and the lows, there is going to be liquidity. What I actually targeted in this trade was some more liquidity that was under here. So above here and below here is going to be liquidity. So we'd already swept here. We had come down, we come down and we inverted. So when we got to this point in the trade, this very next area of liquidity, I would go break even. So move my stop loss to break even. I'm now risk free. What I actually wanted to target though was this area here. So the moment it hit that area, I got out of the trade. Now, as you can see, that was, in hindsight, quite a good decision because it come down and then it reversed. So they're the three things that we're looking for: a sweep and an inversion, and we're targeting the next pool of liquidity. Now, there is one rule that you need to be aware of, and that is that between where you're entering and where your next pool of liquidity is, i.e. here, when you put this tool on your chart, these are just position tools. So you can find them, I believe they're over here. He says, I can't remember where they are now. I have them shortcutted, so I don't know where they are. Let's have a quick look for you. There. So if you look in this area here on your left of the screen, click on, it's the 1, 2, 3, 4, fifth one down. You'll see long position, short position. Put a star on them, and then that way you'll end up with this little movable bar with all of your favorites on it. So once you've entered, you need to make sure that between where you've entered and where your pool of liquidity is a minimum of a 1 to 1R trade. So this at the moment is a 1 to 2.78R trade. So that's fine, it passes. We've had a sweep, we've had the inversion, and now we've got a 1 to 2.8 trade, and that meets the rules. If it was a 1 to 1 or less, it wouldn't meet the rules, so we wouldn't take that trade. So that's the inversion strategy. You need to find a liquidity sweep. You need to find an inversion, so a fair value gap that's been inverted, and you need a minimum of a 1 to 1 before you reach your next pool of liquidity. That in a nutshell is the iFVG strategy. Look forward to seeing you in the next video. Thank you.